Hello, everyone. Welcome to Camel Plan's weekly presentation of the Self-Directed 101. Today, we're going to go over the basics of self-direction. As always, I encourage your participation. Ask any questions when they cross your mind, but you're also welcome to just sit there and absorb the information and listen. My name is William Mucker. I'm a client executive with Camel Plan. Before we get started, just have a brief disclosure to go through. Everything in today's presentation is strictly for educational purposes and not to be interpreted as advice. Camel Plan is a neutral third-party administrator of IRAs. We are not attorneys, financial advisors, or tax professionals. When it comes time when you need advice in any one of those fields, we highly recommend you consult with your team of professionals. We're more than happy to be a part of that dialogue with your team of professionals to make sure the investment process is quick and seamless. But again, nothing is intended to be advice in this presentation, just educational purposes. Some things we'll go over today are the basics of self-direction. What is a self-directed IRA? What types of accounts can be self-directed? What type of investments can be made? What types of investments can't be made out of self-directed IRA? The process, and then we'll go over some minor tax considerations for you to talk to bring to your tax professional to discuss. First and foremost, what is a self-directed IRA? So you can go to Schwab or Fidelity and Vanguard, and they'll say that you have a self-directed IRA. But what they mean when they say that is, here's the list, and you can direct your IRA into anything off of this list of investments. With a truly self-directed IRA, like the ones offered at Camel Plan, there is no list. You find the investment that is right for you, and we will help open your account and facilitate the transaction into that investment. Again, self-direction is just an adjective, which means that you can choose your investments more freely. But in reality, it's just like any other IRA. All the same rules apply: contributions, distributions, and there are a number of different accounts that can be self-directed. This is a quick quote from one of our clients: investing in what you know, understand, and can control versus using hope as your strategy. Most people think you can just invest into publicly traded assets on Wall Street through your retirement plans, where it's kind of like betting in a casino. You have no control over what happens over there, what's discussed in the boardrooms. With the types of investments that are offered in a self-directed IRA, they're more tangible assets that you're familiar with your investing in with your personal funds. You have real estate and investments like that. You can touch it, you can see it. Much more within the realm of control. So like I said, self-directed is just an adjective. But the accounts that are truly being self-directed are these. You have two different buckets. When it comes to these retirement plans, you have your tax-deferred bucket and your tax-free bucket. When you hear tax-deferred, that means when you make your contribution to the account, those contributions are either tax-deferred or tax-deductible. And then you don't pay taxes until years down the line when you go to take a distribution of those funds, including the contributions and anything you've earned in that account. With the tax-free portion, or the tax-free bucket, so to say, you're taxed on your contributions up front, and then years down the line, whatever that's grown to, when you go to take a distribution, those contributions and those earnings, when you take it out, are tax-free. So the way we like to frame it is, would you rather pay taxes on the seed or the crop? With the Roth IRAs or the tax-free accounts, you're more so paying on the seed, whereas the tax-deferred accounts, you're more so paying for the crop. So in your tax-deferred bucket, you have your traditional IRA. You have your employer plans like the SEP IRA and the Simple IRA. And then you have your 401ks and your defined benefit plans and defined contribution plans. It lists spousal IRA there, but that's kind of confusing because a spousal IRA can be a traditional or a Roth. What spousal means really is just that if you have a non-working spouse and a working spouse, the working spouse can contribute on behalf of the non-working spouse, and that could be into a traditional IRA or a Roth IRA. On the other hand, you have your tax-free bucket, which is your Roth IRA. You have your health savings account, which is the only account of its type where the contributions are tax deductible, and then the earnings are tax-free if distributed for a qualified medical expense. You have your educational savings accounts, also referred to as Coverdell's, and then there's 401ks I mentioned earlier. It can also have a Roth portion to it, which would be tax-free. So any of these accounts can be self-directed if you choose to do so. A comparison between 401ks and IRAs. The main differences that you'll run across are the contribution limits tend to be much higher for 401ks depending on the IRA you choose. And then 401ks are the only retirement plan you can take loans from. And it's either $50,000 or 50% of the account balance, whichever of those two amounts is less. And then UDFI rules do not apply to 401ks in most cases, whereas they will apply to IRAs. And we'll go over to UDFI towards the end of the presentation when we get into those minor tax considerations I mentioned. Here's a nice visual that I like to show a lot of clients that are trying to look at the benefit of retirement plan investing. These are 4 different avenues of earnings and what you get to keep out of those earnings. So in this visual, you have $100,000 earned through these different avenues. You have your W-2 salary. You earn $100,000, but in this instance, you're paying federal, state, local, Social Security, Medicare. Your employer's paying taxes, and this may vary depending on where you're located, of course, with the state and local taxes. But in this instance, you're paying about 40% in taxes. So that $100,000 that you earned with your salary, you only get to keep about $60,000. Then another avenue you have is your passive income, where you're not paying that Social Security, Medicare, and employer taxes. A little bit more lenient. Again, it'll vary depending on where you're located. But in this example, you're paying about 25% in taxes, where instead of $100,000, you're walking away with $75,000 and sending $25,000 to Uncle Sam to help him keep the lights on. And then at the bottom, you see the tax deferred and tax-free accounts we mentioned earlier. $100,000 earned in these avenues as $100,000 cash. However, there is an asterisk next to the tax deferred section. This is to note that when you do go and take it out of the account, at that time, it's going to be taxed at distribution. Whereas a tax-free account, if you're at a qualified distribution age, that's $100,000 in your pocket, tax-free. So I'm a little partial to the Roths, and that's why. This is another visual comparison of these different accounts. So in this example, you have $50,000 over 40 years at a 10% rate of return in a 30% tax bracket. Invested through taxable funds, your tax-deferred or traditional IRAs, and then your tax-free or Roth IRAs. At the end, it's important to note that both the light green and dark green, the tax-deferred and tax-free, both earned $2.2 million. However, when you went to go take it out of your tax-deferred IRA, that light green, you paid $700,000 in taxes, whereas the W-2 salary only earned $700,000. So again, investing in your retirement account is very beneficial in this example, and even more so in the Roth IRA. So the most common questions we get when we answer the phone for people and looking into investing with their self-directed IRAs, what types of investments can I make? Can I make this investment? So most commonly we see our investors or our clients invest into these asset classes. You have real estate, you have private lending, you have privately traded companies via private placements, you have precious metals, but you're also not limited to those categories as well. I've seen people buy bees and sell the honey. I've seen people invest in companies that planted trees and sold the fruit. I've seen people buy sheep and sell the wool. Not very common, of course, because they're a little bit different. But again, you're not limited to those asset classes above. And we'll go over each of these a little bit further in the next few slides. So like I said, real estate is one of our most popular assets. And when I say real estate, it can be single family, it can be multifamily, it could be residential, it could be commercial, it could be developed or undeveloped land that your IRA owns. But the way it works is that the owner of that property is not going to be you personally as the account holder. It's going to be the IRA, which is a separate entity from you, similar to a trust. And we'll go over that a little bit further when we go over the process itself. Another thing you can do with your self-directed IRA is you can turn it into a bank. Your IRA can become a lender. It can be invested into promissory notes. They can be secured. They can be unsecured for whatever reason. And if you secure it, you can secure it to a property and via mortgage. They can be convertible notes that turn into equity into a company at a given time. You do not need to originate the note. You can purchase a note on the secondary market. Again, you can turn your IRA into a bank by utilizing private lending through your self-directed IRA. Probably the most common asset we have at Camo Plan our investors like to do, because it's the most passive, I would say, out of most of these, is private placement. So before, Apple or Google or any of these companies went public, you couldn't invest into them with your IRA unless you did it through a self-directed IRA via what's called a private placement. With those, they have a subscription agreement. You purchase shares of the company, but it's prior to them going public. Another common investment class that we have is precious metals. So your IRA can own gold, silver, palladium, platinum. There's also a metal called the precious metals composite, which is a combination of all those metals that I listed prior. And certain coins like silver eagles can be owned by your IRA. However, you can't have personal receipt of these metals, so they have to be stored in a depository, which we help do for you. Now, we just went over a few things that you can invest in with your self-directed IRA. Now let's talk about some of the things you cannot invest into with your self-directed IRA. So the most common things are collectibles and life insurance. These are hard to value assets. The IRS doesn't want you holding these within your self-directed IRA. Some of those collectibles come in the form of art. So you can throw paint on a canvas, and some person can say it's worth $100, and some person can say it's worth $1 million. So they're hard to value assets. You also have, rugs or antiques, metals or gems. However, below you see that exception for those metals that I mentioned in the previous slide. Stamps or coins, alcoholic beverages like wine, they cannot be held directly by the IRA as an investment. However, you can invest into companies that do work with these asset classes via private placement, but you cannot directly, or should I say your IRA cannot directly invest into these. Other things that are prohibited within a self-directed IRA by the IRS, again, we don't make these rules, as there's no self-dealing and there's no sweat equity. So if your IRA goes out and purchases a house, you as the account holder cannot live in that property at all. You cannot stay in it even one day out of the year. And you can't put any sweat equity or any work into that property yourself. You can't go in there with a paintbrush and paint the walls. You can pick the color of the paint. You just can't go in there yourself and paint the walls. You're not paying taxes on the income you earn in this investment. So the IRS wants your IRA to go out and pay somebody who's going to charge a competitive price that will be paying taxes on the income they earn from that work to do the work. And it's not just you who are subject to those prohibited transactions within your own IRA. It's these people on this chart. So anybody in blue is considered disqualified. Anyone in green is okay. So anybody of lineal ascent or descent of you, including parents, grandparents, children, grandchildren, their spouses, and any entity that these people own 50% or more of or have managing power of, are disqualified or prohibited from receiving a direct benefit from the IRAs and its investments, nor can they provide a direct benefit to the IRA and its investments. So your IRA can't hire your child's painting company to go in and paint a property owned by the IRA. That would be considered a prohibited transaction. However, the people in green are okay. So lateral relationships like aunts, uncles, cousins, siblings, nieces, nephews, they're okay. Whatever reason behind that, I'm not too sure about, but the IRS made these rules, not myself. All right, we'll go over the process and how it works. We'll also go over the timeline in this as well. So basically, when you figure out you want to start investing with a self-directed IRA, the first step is to open up an account on Camo Plan. It takes about 50 minutes. It can be done online. You can have myself or another representative walk you through the process over the phone if you even like, or come into our office and we can help you do it as well. Then you fund your account. Funding the account can be done one of three ways. So you can either contribute to it with your personal funds like any other IRA. You just have to make sure you're following that specific account's contribution limits, depending on the account you open, of course. The other two methods are very similar, but different in their own way. You can either transfer from an existing IRA. So IRA to IRA is considered a transfer. But if you open up an IRA and you have a 401k that you're able to roll into it and fund the account with, that would be considered a rollover, which is a little bit different. Transfers we can initiate on your behalf from the other custodian. Rollovers you would have to initiate yourself. That process takes about 2 weeks on average. It could be much quicker. It could take a little bit longer. We're not in control of that timeline. That's more so on the individuals that are sending the funds. I've seen people get funded as quickly as the next day. I've also seen people wait 2 weeks or longer, depending on their current custodian and other factors. Once the account's been funded, you'll receive an email notification from Camaplan, and you'll be able to log in and see those funds within your IRA on your online portal. At that point, you can identify the investment that you want to make with your self-directed IRA, whether that be real estate, whether that be private lending, whether that be private placements. You'll find that investment that's right for you. Work with that investment provider or your realtor. Let them know that you're planning on investing with a self-directed IRA. The process is fairly similar. Then when you've done that, you'll submit the paperwork necessary for us to process that investment. Again, it varies depending on the investment you choose. But let's say, for example, you decide to purchase a property. So what we're looking for is our asset purchase directive, which goes with all of our investments. It tells us what you're investing in, how much you're sending. Is there an initial payment that needs to be sent? How we're sending and how you'd like it sent. Where we're sending and how you'd like it sent. And then with that, the supporting paperwork, again, varies depending on the investment that you make. For real estate, we're looking for an agreement of sale made out where the purchaser of that property is the IRA, not you personally. So rather than you being on that agreement of sale as the purchaser, it's going to be something along the lines of Camaplan, FBO, which stands for benefit of your name, IRA or Roth IRA, whatever type of account you have with us. And then you'll initial next to the signature line for that IRA. And your initials let us know that you've read and approved of that agreement, because we're not reviewing these documents to make sure it's a good deal for you. We're just reviewing it to make sure it's titled correctly. You'll send that into us. We'll process that within 2 business days of receiving paperwork in good order, like we do for any transaction. And then, assuming everything's in good order, we'll sign on behalf of the IRA's third-party administrator, follow the instructions you gave us on that asset purchase directive, send the funds to the title company or your investment provider, and then you'll be able to log into your online portal and see that asset within your account. And then all proceeds from that investment will be returned to the IRA, and then you can transfer it back out to your other IRA that you're doing the publicly traded assets in, or you can keep them and reinvest them into other deals, self-directed or alternative deals, should I say. So in total, from the date you open your account to the date you make your first investment, I tell people to expect on average about 3 weeks. But again, it could be much quicker. It could take a little bit longer. But everything on our in-house with us is processed within 2 business days of receiving paperwork in good order. The biggest chunk of that time being the funding of the account, the biggest variable. But we help prepare you for that and give you tools to expedite it if possible. So why do you need us? What do you need Camaplan for? Why are we in business? So the IRS actually requires you to have a third party keep record of the transactions within the IRA and report to the IRS at the end of every year. And that's what we do. We're neutral. We don't tell you what to invest in. We don't call you about investment advice or the next shiny deal that you can invest in. We strictly facilitate the transactions, keep record of the transactions, and report to the IRS at the end of every year. We're part of your core team of professionals. Like I said in the beginning of the presentation, bring in your attorneys, your tax professionals, your financial advisors. We'd love to get on a phone call with you and them to make sure that everybody's aware of the processes that'll take place and to structure it based off the advice of the professionals you trust. These are some frequently asked questions. We did hit on a lot of these, so I'm going to skim through these. But if anybody has any questions at any point, like I said, please feel free to post them in the chat. I'll be happy to answer them. What is the timeline to open and fund a self-directed IRA? Again, about 3 weeks on average from the date you open the account to the date you make your first investment. But there's that variable of how long it takes to get funded that we're not too much in control of. Next question, how do I fund an IRA account? How long does it take? We went over those 3 options, either contribution, transfer, or rollover. Contributions will be done almost immediately. Most likely you can do that. Most often it's done via e-check through your online portal, and that's done very quickly, almost immediately. But if you're funding it one of the other methods, which are more common, transfers or rollovers, again, we said about 2 weeks on average, but it varies. Walk me through how I'm investing in an asset through a self-directed account. We used that example earlier about real estate. You identify the investment you want to make. You submit the investment paperwork, which includes our asset purchase directive and the supporting paperwork. So if you're lending money, we'll look for a promissory note. If you're investing in private placement, we'll be looking for something like a subscription agreement. If you're investing into real estate, we're going to be looking for something along the lines of an agreement of sale. If you're investing in precious metals, you'll have an invoice from the precious metals dealer that you're investing in. Send that into Camo Plan together, completed in good order. We'll process that within 2 business days and send the funds to the investment provider. Who signs the paperwork when I invest? More often than not, 99% of the time, Camo Plan will sign on behalf of the IRA as third-party administrator. Third-party administrator, provided that you have initialed the paperwork next to the signature line for the IRA, because that lets us know that you've read and approved of the agreement. The only instance where that changes a little bit is promissory notes. In those examples, more so, you'll sign on behalf of the IRA because we view those as more of an agreement between you and the borrower than it is between us and the borrower. Can I use my IRA for the down payment of a property I want to own personally? This is actually a very common question I get. The short answer is no. The long answer is whatever percentage the IRA owns of an investment is a percentage of all expenses it has to pay and all return it's entitled to for that asset. So in order for it to pay 100% of the down payment for a property, the IRA has to own 100% of the property. And that means it'll be responsible for 100% of the down payment, 100% of all utility bills, 100% of any renovations, 100% of all expenses for that property, but it'll also receive 100% of all the returns. So any rental income or the eventual sale of the property would go back 100% to the IRA. Now, if the IRA only owned 50% and you wanted to partner with a different entity, which is a possibility, that I'm happy to discuss offline, or if anybody has any questions about it in the presentation today, I'm happy to discuss. But if the IRA only owns 50%, then you just replace that 100% with 50%. And it's responsible for 50% of all expenses and entitled to 50% of all return from that investment. Can my IRA receive a loan to purchase a property? The answer is yes. However, it's not going to be through what your traditional loan that you're going to find at a bank. It has to be through what's called a non-recourse loan. The reason for that is you can't personally guarantee the loan. So the only recourse the lender has is you can't personally guarantee the loan because the loan is being made to the IRA, not you personally. And in addition to that, the only recourse the lender has if the IRA were to default in a payment on that loan, we usually go after the property in which it's secured to. And at most, it can only go after the assets within the IRA the loan was made to. They can't go after any of the assets in your other IRAs that Camo Plan. They can't go into your IRAs outside of Camo Plan, and they can't go into your personal belongings. So usually with these stipulations, the requirements for these notes are a little bit higher and the terms are a little bit different. So if you want more information on the terms of these notes, I'm not familiar with them. You would need to talk to a non-recourse lender. Can I manage the property my IRA owns? It really depends on your definition of manage. You can pick the color of the paint you want to paint the walls. You can pick your tenants. You just can't go in there and do any of the work or that sweat equity that we mentioned in the prohibited transactions section of the presentation. So yes, you can technically manage it if that's what your definition of management is. Your IRA can also hire a property manager to do all of the management. But it really depends, again, ultimately depends on your definition of management. You just need to follow the prohibited transaction guidelines, but outside of that, you're pretty good. Last of the frequently asked questions, what do I do if/when there is a capital call or an installment payment I need to make on one of these investments? So some investments, some private placements in particular, they're called capital. So you'll put an initial commitment down, and then over a certain period of time, they'll call the capital and ask you to send more money in for your investment. If that's the case on the asset purchase directive, it'll ask you, is there an initial payment to be sent, and what's the total purchase price of the investment? The total purchase price is the entire amount that you plan on investing over the duration of the investment. And then the initial payment amount is that initial commitment we mentioned earlier. You'll list that We'll send that initial payment, and then whenever you need to submit a capital call, what you'll do is you'll go into your online portal, you'll submit a payment request for additional funding, and attach a copy of that capital call that they send you, and then we'll process those usually within 1 business day of receiving them and get that money out for that capital call. This also applies for if there's installment payments on a loan that you want to make out of your IRA as well. So lastly, like I mentioned, we have some minor tax considerations that you could take to your tax professional. These are a little bit more advanced, I would say, when it comes to talking about self-directed IRAs. They're not very common, but they do occur, and it's a nice thing to learn about if you're planning on doing these self-directed investments, and it's definitely a good conversation to have with your tax professional. Usually IRAs don't pay taxes, but in some instances they do. Those two instances are UDFI or UBIT or UBTI, also referred to commonly as UBIT or UDFI. So those two examples, UBIT or UBIT is unrelated business income tax or unrelated business taxable income. The thing that triggers this often is basically the IRS thinks you're running a business out of your IRA, and it's partaking in actions that the IRA was not intended for. So the most common things that trigger UBIT within an IRA are, at least from what I've heard, are flipping properties. The IRS will look at the properties as inventory in and inventory out, and they'll say that you're running a business. Now, what the IRS's definition of a flip, they'll never say. Some people say if you hold it for a certain amount of time, you're okay. Some people say if you only do one flip a year, you're okay. But those people are not the IRS, and the IRS, again, will most likely never say. So if you think what you're doing may be deemed as a flip, again, talk with your tax professional. The other thing that tends to trigger UBIT or UBIT is developing on undeveloped land. So if your IRA goes out and purchases a plot of land, and then you decide at some point that you want to build on that plot of land, and your IRA goes out and pays a developer to start building on that land, the IRS may look at your IRA and say, hey, you're running a development business out of that account. You're going to get hit with UBIT. Again, if you think if you're planning on doing that, or you think you maybe do these taxes, talk it over with your tax professional. Not very common that you'll have to pay these taxes, but it can occur. The next thing to take into account is UDFI. Some people will say UBIT and use it as an overarching umbrella, and in reality, what they're actually talking about is UDFI, which is kind of like a subcategory of UBIT. UDFI stands for unrelated debt financed income. It's whenever you receive revenue that's based off an asset that has an outstanding debt. So if your IRA goes out and receives a non-recourse loan, like we mentioned in the last slide, you could be responsible to pay UDFI tax. Either way, if either of these taxes are due, again, talk it over with your tax professional. They'll let you know how much you have to pay, if you have to pay anything. They'll file Form 990T, and you'll send that in to us, where we'll review it, sign on behalf of the IRA's third-party administrator, and release those funds directly to the IRS on behalf of the IRA. People I've heard that have had to pay this tax are usually okay with it, because they would have had to pay these taxes outside of the IRA if they wanted to do this investment outside of the IRA, and they're still using it to grow their retirement plan faster than what they'd be doing it in the investments they did prior to doing that deal. So it really depends on the lens you look at it through and the deal itself. Again, I'll say it's not very common, but it is something to take note of, and definitely talk it over with your tax professional, because I am not one. Here's some of the articles that we pulled all of this information from to make sure to let you know that we didn't just make this up. These are different publications, different court cases, different forms that will be used. You see that Form 990T that I mentioned earlier. If you have trouble sleeping at night, you can look into these, keep these by your bedside. I'm sure they'll help you. But again, these are just to prove to you that nothing we talked about today isn't backed by these different articles that you can do your own research on as well. Here's my contact information if you or anyone that you know can benefit from the information that we discussed today, have any questions, or maybe want to talk about what you're thinking of doing, I'm more than happy to talk to you. I love talking to people about what they're planning on doing with self-directed IRAs and hopefully teaching people things. So if you have any questions or you have anybody that you know that may have questions, please feel free to reach out to me. I'm always happy to help. And I don't know if we're going to have any questions. It seems like there will be no questions today, but if you have any questions, if you're watching this recording in the future and you have any questions, please use this contact information. Don't be shy. Again, I really like talking to you and hearing your questions and hopefully pointing you in the right direction if possible. So I thank anybody who attended, anybody who watched who's watching the recording now. Really appreciate you lending the time. And I hope I was able to share something with you didn't know. Have a great rest of the day.